One of the major problems traders face is not knowing when to buy and when to sell. And this has been costing them to take significant losses. And in this video today, I'm going to share with you my thought process, how I know when to buy, when to sell, areas to exit the market. And in this video today, we're going to be using US NAS100 as a point of reference. And right here, as you can see, we're currently on the 4-hour time frame. And as you can see on the 4-hour time frame, right here, the market was consistently creating higher highs and higher low, higher high and higher low. Right here, higher high, right here, higher low. And this low right here actually got broken right here. And this was the last impulse move before dropping to break this structure right here. Now, if we go to the daily time frame to actually have a better overview of this price action, you can basically see clearly right here, price created a low, created a high, dropped down, breaking structure. After this break of structure right here, what I'll be anticipating to see when price comes up here is a sell. I'll be looking forward for a sell. Now, the reason is because, now I need you to understand something, right? For you to know whether to be a buyer or seller, the first thing to understand is the market structure. Are we bullish or bearish? In this case, despite the fact that overall on the monthly time frame, we're bullish, on the daily, we have this break of structure right here. And after this break of structure, the next thing I would like to see is a retest and then a potential drop. So even if price is going to continue to the upside, I won't be surprised to see a sell-off when price comes to a premium. So after understanding the market structure, in this case right here, we have a break of structure. So I'm anticipating for a sell. The second thing I'm looking for is for price to come into an extreme level. And that extreme level in this case is extreme premium. And right here, this is my extreme premium. If you draw the Fibonacci from this overall low to the overall high, this right here is extreme premium. So price coming into an extreme premium, I'm looking for a significant break of structure. And this is 4-hour break of structure, minimum a 1-hour break of structure from this key level. Why 1 hour? Why 4 hour? Because if we go to the weekly time frame, we can see clearly on the weekly time frame, there's this inefficiency resting right here. You can see that very clearly. So I wanted to see a mitigation there. After that mitigation, I'm looking for a 4-hour break. And right here, you can see a significant low, significant high, drop, break structure. This inefficiency here is my entry position. And the red line, you can see the red line right there. That's my entry position. And why that red line of all places? Why did I choose that red line? I'm also going to share with you the reason why as well. The reason for that is because right here. So the reason for that is because if we look at that red line, you can basically see. So let me bring this down 1 second. So my stop loss is going to be the overall high. The red line is my entry. If we use the line chart, you can basically see that this key level right here, this is the low, the bodies of the candle, this is the high. Now I'm anticipating for price to mitigate the bodies of that candle. Now let's go back to the bar chart to see what it looks like. And you can pretty much see how perfect that is. Perfection. How price literally came into that position, tapped it in, and then the next thing we saw was a sell-off. You can literally see that right there. Stop loss, this high. Why is this key level my stop loss? Because this is a high resistance liquidity. Now, if I want to take a sell and I want to place or a buy, I want my stop loss zone to be a high resistance liquidity. High resistance liquidity simply means an area that price will find difficulty to rally or drop below. And this key level is a significant 4-hour high resistance liquidity. So I wouldn't be surprised if price comes in here and rejects impulsively. Now, where will I be aiming for price to drop into? Equilibrium. Where's equilibrium? This right here is an equilibrium zone. The moment price comes down there, I'm exiting every single position, and that's a 1:7 risk to reward ratio. And if we go to the daily time frame, we can also see that key level has an inefficiency, making it a high probability area for the market to draw into. And the moment price comes in there, I'm out of the market, because anything can happen from here. We can literally reverse from here, or price can still decide to continue lower, because right here we have a low resistance liquidity, and you can see all my checklists, the things I like to see before looking for a potential sell. First one here, 7-day opening gap, and if we go to 7-day, you can see on the 7-day, you can see there's an opening gap, open range gap right there. That's my first confluence. My second confluence, weekly fair value gap, you can see the fair value gap. Then the third confluence price, it's an extra premium right here. I talked about it. And then fourth confluence is there was a 4-hour break of structure, which I also outlined right here. 4-hour low, 4-hour high break of structure. And then another one is the high resistance liquidity at the new high created, which is right here. So you can see the things that I'm looking out to see in the marketplace. And there's a fair value gap at the 4-hour point of interest I want to sell from. And you can see the fair value gap, the inefficiency. That is my entry position. Stop loss right here. So this is a very simple process. And if you found this video insightful, just give it a thumbs up, or you can follow me for more content like this. I'll see you in the next one.